C corporations have unique benefits and some unique challenges. That's why in this video, I am going to be going through some of the most powerful tax strategies that C corporations can use to minimize their tax bill and overcome their challenges in 2024. But before we jump in, I'm gonna need you to like, comment, and subscribe so you don't miss out on any of this wealth building information. Now, let's get after it. You might be thinking to yourself, when do people use C corporations? Are C corporations only for big corporations, the Yahoos out there, the Googles of the world? No, not necessarily. People use C corporations for various other reasons as well. One reason why a person may use a C corporation is because C corporations will allow you to have off-year closes, meaning that you don't have to close your year at December 31st. If you need another entity that maybe has a June 30th close or a September 30th close, you would want to be in a C corporation. You might also choose to be in a C corporation if you need to raise capital or you want to take your company public. You have to be in a corporation to go public. So realize that C corporations are not necessarily driven fully by the amount of money that a corporation makes. It's really driven by the vision that the corporation has. And owning a C corporation is a very effective strategy in order to lower your individual tax liability if you're operating as an S-Corp or an LLC. Possibly an off-year C-Corp where you pay your consulting company is a very, very unique strategy and one we can talk about. C corporations have a flat 21% tax rate. That means that any net profit that a C corporation has at the end of the year is going to get taxed at a flat 21%. Therefore, if your corporation made $100,000, we can do the math very easily. You're going to have a $21,000 tax bill at the corporate level. Every state has its own corporate tax rates, but realize that is a win to be inside of a C corporation. However, you got to be careful of the double taxation, because if a C corporation has that profit left over at the end of the year and you are retaining that profit in the corporation, when you get ready to pull it out, the shareholders or the individual officers will be taxed at the individual level. That's why it's so imperative to make certain that you understand how to manage the taxes of operating a C corporation. C corporations allow you to take advantage of deductions and credits. Allow me to give you an example. If you are going to be operating inside of a C corporation, chances are everything that we're doing inside of that corporation is going to be in the name of the corporation. As an example, I may have a vehicle that will now be a commercial vehicle because I bought it in my C corporation, which means that all of my car expense is going to get written off inside of the C corporation to lower the taxable income of the corporation, meaning that me, the shareholder, may report less income on my personal return because I am allowing the corporation to absorb some of the expenses that could either be business or personal. In addition to that, your C corporation can utilize credits, the work opportunity tax credit, the healthcare credits. There are so many credits for corporations, research and development credits that you can utilize. So when you find out that somebody has opened their business as a C corporation, when you find out that they make it a big deal by going to a particular state to operate, that is because there may be state credits there, or there may be no income tax there, or they may be credits that that corporation is going to utilize to minimize tax. C corporations are notorious for deferring income and accelerating their deductions. When you are a C corporation, chances are you may be on what we call the accrual basis of accounting, which basically means I'm only going to report the income if I've earned the income. What does earn the income mean? That means that I may have sent out a lot of contracts and I may have all of this money coming in, but technically I have not earned that income because I have not done what's required to deliver to that particular client. Allow me to give you an example. Let's say that I'm a contractor and I sign a contract with that contractor for them to redo my home, and that's a $200,000 contract. And let's say I paid for it all up front. The contractor now has that money. The contractor is not gonna report that $200,000 on their taxes. Why? Because they have not performed. They have not done the remodel. They have not done the build. Therefore, they have the $200,000 and they can use it, but they don't have to report it as income. So being a C corporation can be very beneficial when you can use the accrual method of accounting. C corporations can utilize the dividends in order to pay out profits to their shareholders. When you're inside of a C Corp, there's multiple ways to get paid, but I can elect to pay myself a dividend, and that dividend can be taxed at lower tax rates. Therefore, I can not only control the taxes at the C Corp level, I'm able to control the taxes at the individual level if I am the shareholder of that C corporation. Understanding that C corporations have multiple ways for you to get paid and how to use them to minimize taxes is very, very key in maintaining an effective strategy of tax reduction at the C Corp level. Fringe benefits in a C corporation can be massive. You can deduct your healthcare benefits. You can have a Section 125 cafeteria plan. You can set up 401ks. You can do so many things at the C corporation because when you are a C corporation, you're considered to be at arm's length because the corporation is owned by shareholders. Therefore, those shareholders vote to make certain decisions. So IRS allows for C corporations to have better fringe benefits. When you see all of these corporate officers flying on these jets, taking their families, driving nice cars, having gym memberships, and all the other things that come with it, believe me, it is wrapped up in some type of legal fringe benefit plan that is allowed by the tax code. That is why C corporations are great when you're looking for fringe benefits. As a C corporation, this is a great entity to be in if you are operating abroad and you need to have international tax planning. There are so many ways that you can actually apportion your income among different countries and get various tax deductions in the States. So understanding that a C corporation has great tax planning benefits with it is a key component to reducing your overall tax bill. That is why I say, my friends, that many people will open up a C corporation because they understand the dynamics of operating a C corporation, needing to raise capital, wanting to get investors, wanting to go public on the New York Stock Exchange, wanting to make certain that you don't have any flow-through income coming back to your personal return, wanting to make sure that your personal return shows you as a W-2 wage earner so you can easily qualify for a home loan, because many of us know business owners struggle to qualify for home loans. Understanding you can have great fringe benefits, understanding that you can operate globally, understanding that you can get paid 3 ways out of a corporation, dividends, you can get paid by taking a salary. You can even loan yourself money from the corporation as long as it's voted in by your board of directors and you paper that loan, pay interest appropriately. Having a C corporation is all about the appropriate strategy. It's all about understanding the code and reducing your tax bill. So if you're considering going into a C corporation, You now know all the benefits of what you need to be looking out for. And you already know, when you know better, you absolutely have to do better, which is why I'm going to ask you to share this video, like, comment, and subscribe, because we can no longer afford to miss out on any wealth building information. Go get after it.